We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong with David Ingles.
Good morning. Let's get to your top stories today. Markets, we're looking at stocks across the Asia-Pacific down. Following losses on Wall Street, you have President Trump raising the pressure on Jay Powell to cut rates again. Now, investors are piling into gold as the Sell America trade gains momentum. Now, we have markets here in Hong Kong set to reopen today, set for a cautious reopening after the long weekend. U.S.-listed Chinese shares, though, toppled the sort of downtrend overnight with calls mounting for Beijing to pull the trigger on more stimulus. And a new breakthrough in China's EV sector with CATL teasing tech that promises hundreds of kilometers of range after just a 5-minute charge. Good morning and welcome to the show. We are looking, of course, at the reopen of markets here in Hong Kong. We'll get to that in a moment. The broad read-through, though, across risk assets in the region, and as you can see, euro dollars to the negative right now, is really one of risk aversion. We are extending some of the caution we had overnight, and as you can see, most of Asia is down. You have Taiwan, which fell 1% yesterday, down a further 1% in the early goings. A reversal of sorts, which is a good thing, right? So Brent, big drop on Monday. The dollar, massive drop on Monday. We're seeing a reversal of that, and in fact, we're steadying right now as far as U.S. futures go. Right. One trade that has remained consistent is really gold, right? So you look at the futures curve right now. What's interesting, then, we'll show you some data later on as well. As prices continue to hit new highs, you're looking at everything from June all through October, speculative positions on gold have started to come off a little bit, which might be, I guess, in some ways, maybe a forward-looking indicator of expectations from speculators here. Right. Now, that being said, of course, we're continuing to track gold and gold-related stocks across the region. We mentioned this at the very top, right? Bucking the trend, the weakness overnight. Golden Dragon Index up about a fifth to 1%. Some of the EV plays very much in focus, some of the tech plays as well. We'll look at Meituan later in closer detail because of the JD.com and their foray into the general business of Meituan. We'll talk more about that in a moment. Very quickly, the approach to the open, you have A50 futures, Singapore, Hong Kong, and the Hong Kong dollar is, as you can see, very close to the strong end of the trading band. And of course, the HKMA has come out and said they are prepared to sell Hong Kong dollars in the event they do need to, of course, defend the peg. Okay, very quickly, take a step back, right? The drop overnight in U.S. equities has effectively meant that for April, and we have about a week left still, that the S&P is underperforming the rest of the world. So we're looking at MSCI all-country world in U.S. dollars, so it strips out the currency, excluding the U.S., it strips out the U.S. It's the worst month for the S&P relative to the rest of the world, going back to April of 1993. And on the April note, let's bring in Avril. Avril.
Yeah, I mean, you talk about how the S&P has been lagging. It's really against this backdrop of tariff uncertainty, the back and forth when it comes to policy from Trump, but also how he's kind of doubled down on his attack on the Fed chair, and he's stepping up pressure on Jay Powell, warning that the U.S. economy may slow if the Fed does not immediately reduce interest rates. Bloomberg senior editor Derek Wallbank is with me now in the studio. So, Derek, talk us through what we're hearing from both Trump as well as some of his officials in what we might get in the way of terminating the Fed chair.
Well, look, Avril, you're right. This is something that I think has caused markets to take a second look. Fed independence is a bedrock policy of the United States, and it is something that one does not mess with without some amount of consequence. And we've seen some jitters in the markets reflective of some of the concerns that may be under threat. Certainly, Trump has said for a long time, and I need to context with this, he has said for a long time that he has the absolute right to give his opinion on what the Fed ought to do. Whether the Fed takes that up or not is another story. And he has not been shy that he thinks that the Fed needs to lower rates across the U.S., make things cheaper to buy, also decrease a little bit of pressure on debts more broadly. And he's doing an interesting move here because he's saying that if the Fed is not so accommodative, it could have economic pressures. Now, we're seeing surveys suggesting that there are indeed economic clouds on the horizon for the United States, not least of which from Trump's tariffs. So some of this may be an attempt to sort of blame shift if things go wrong. But the other thing that I think that is maybe not quite so appreciated, but bears a lot of mention, is if you go back to Trump's first term and the initial launch of the trade war, you will find a Fed that was quite accommodative in trying to de-risk those policies. That has not been the immediate case from the Fed just yet.
Okay, Derek, still on Trump here. So we had executives from the large U.S. retailers, Walmart, Lowe's, Target, meeting with the U.S. president. What happened during the meeting? What did they ask for? And is the president about to give in?
Well, every time you say those companies, Walmart, Target, Lowe's, Home Depot, you should read in your mind extremely tariff-exposed retailers in the United States, right? Lowe's and Home Depot are home improvement companies. These are places that you go to when you feel like you have extra money and you want to spend that money making your house nicer. They are exposed not just on imports from abroad for finished products or washing machines and dishwashers and things of the like, but also on some of the tariffs that Trump has threatened, lumber being a really big one, a lot of that from Canada. And when you're talking Walmart, you're talking Target, you're talking about all sorts of finished good product imports. Toys from China, I think, is one of the big ones that's mentioned a lot, textiles, clothes, things of that nature, as well as frankly, and overlooked groceries. So they really represent retailers across the broad spectrum of potential Trump tariff afflicted. Now, the retailers have come out of this with a range of different comments. All of them were sort of broad on sentiment, light on details. The sentiment, this is a positive meeting and things like that. Hard to take any specific policy outcomes from that. But the retailers will be glad to have had the audience and glad that Trump is listening. And look, David, I think the big question that you're getting at is one that everyone sort of got, right? This difference between the maximalist Trump threat and what he's actually going to promulgate. We are under a 90-day pause while Trump searches for details for most countries, not China, but most countries. And so what is that going to do? What's going to happen as a result of those pauses? Who's going to get them and which product lines will be affected by that? Those are all live ball questions, as well as whether or not there's any move between Trump and Xi Jinping over the next insert time frame here to maybe de-escalate that and de-risk ahead of a Christmas shopping period that these retailers are already going to be well into plans for.
Yeah, it's been supply chain turmoil for these retailers in the U.S. But talk to us also, because you talk about this 90-day reprieve. What we're also seeing is fresh solar duties on Southeast Asia countries. I mean, cumulative effects that they're already grappling with, given these levies that they are threatened with from the U.S. What are we looking at here? What's the state of play?
Yeah, that's right, Avril. And look, it is back to the future in a way, because the very first two tariffs that Trump did as the very start of his trade war were washing machines and solar. So solar literally came second. And so this has been a long time coming. Now, this one is not solely at Trump's feet, right? This was an investigation launched in the Biden administration. The timeline happens to put it into the Trump administration. It could have easily come in a Harris administration had things gone different in November. So this is a little bit different than Trump's normal things, but it does stack up in the overall tariff landscape. There is a concern in the U.S. About solar finding its way deeply discounted in as the U.S. tries to protect its nascent industry as well as stop transshipments in from China. So a lot of those things are at play there. But overall, this is going to add to the pressure of those Southeast Asian economies, many of which, though, I hasten to add, are in talks with the Trump administration for some easing. Vietnam immediately comes to mind among them.
Derek, thank you so much. Derek Wallbank there, our senior editor in Singapore for us. How do we deal with this from a market perspective amid the sort of dizzying array of market signals and noise out there? Ecaterina, Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers, here with us in our studios. Good morning and nice to see you. Hopefully we've seen more quiet times, let's put it that way. What markets have done is, well, we wait for more clarity and detail and stuff to stop moving. They've sold the dollar down and they've sold U.S. assets down. What's your advice, Redna, in terms of exposure to dollar assets?
Look, I think ultimately, clearly the tariffs, as know, it's a front stage. It's bringing a lot of uncertainty to investors. It's bringing a lot of questions around what is the path from here. So obviously we had escalations, then de-escalation. And I think for a lot of companies and investors, this is a very uncertain environment. And we're of the view that, of course, the sooner this gets resolved, the better it is for the companies, the ability for them to deploy into growth, to deploy into leverage again, and start operating into the new norm. But we don't have yet that new norm. And I think in terms of the broader landscape, I think if you look at the drivers of returns, I would say year to date, and I would say going into latter part of the year as well, we've had obviously tariffs and policies from the U.S. that are driving some of the returns. Yeah. We had obviously fiscal policies in Europe that has singled out Europe in some ways, particularly Germany, as a potential long-term growth recovery story. And then obviously we still have tech, which is simmering in the background. It's probably not front of stage, but it's still a theme that is in the background. And ultimately, I think as we go further down the line, all of those three will still be part of the narrative and part of the outcomes into the year end. But clearly, as we see from the Trump, it is with all this uncertainty, policy has a lot of weight to drive returns, right? And we know that the policy response, whatever that's fiscal, for those that have the space, or monetary, will still have a weight. And clearly, we see how the Trump is trying to shift that policy support into favor for U.S.
So the strategy would be stay nimble, stay defensive. Is that cash? Is that short-term securities? What's the advice?
Certainly stay nimble, but I say those catalysts that I've talked about, when you look at tariffs, I think it's fair to say that a lot of the, not just in the U.S., but also globally, that the economies that are more onshore focused, sectors or companies that are more onshore focused are deemed to benefit or have a larger scope to perform better into the year end. Obviously, companies that are still exposed to the tech or the AI theme, it is still a theme that is a secular theme. This is still happening. It's happening in China. It's happening in the U.S. Again, it's a different pace and certainly a different spotlight, but we still staying constructive on tech. I think that has scope to perform. But certainly looking at companies, particularly now that we're earnings seasons, we're going to closely watch what are the earnings are, but also what the guidance is. So staying into that quality, but also not forgetting that some of those themes that I talked about are likely to drive returns as we go further down into the year.
Ecaterina, Avril here. I'm just wondering, when it comes to some of these trades, do you think they've come too far, too fast? I mean, you look at the euro and everything that's happened, but this is coming against the backdrop of an ECB that is cutting. I mean, quite different from the rallies that we've seen in the past in the single currency.
Yeah, no, I mean, I think, look, I think the outcomes of the monetary policy divergence between the U.S. and the Eurozone certainly is going to drive that currency weakness. But ultimately, what has driven the biggest weakness in the dollar is that appetite, as David has mentioned, the appetite for dollar assets more broadly, which is putting additional level of pressure. And ultimately, you have to look into the campaign that Trump has had. I think dollar weakness is not necessarily a negative thing. I think excessive dollar weakness is probably negative, but some dollar weakness is probably welcomed. I think it will bring some competitiveness to the U.S. goods. So I think ultimately it's not a bad thing. I think going further into further weakness from here, I think it could obviously exacerbate the situation and maybe the appetite for dollar assets. But at the moment, it's not yet in that situation.
Just very quickly then, since we're in the U.S., how do I need to be thinking about the noise around the Fed chair? Like, is his position in danger? Because markets seem to be moving risk-averse along, regardless of whatever scenario we find ourselves in there?
Look, it's an uncertainty, and market is very sensitive at the moment to uncertainty. And if you had to say, during the campaign, when Trump has had his campaign, he voiced that Jerome Powell is not his pick in his team. He picked his team. He didn't have a choice on the Fed. And it was always clear that it's going to be a difficult relationship. Yeah. Whatever he has the scope and the bandwidth to actually have him resign or have him displaced until his term is finished in 2026, this is, again, a big question, right? So we know that there's section number 10, which says that, of course, the Fed has to do significant miscalculations for them, or the chair itself, to miscalculation for them to be displaced. Yeah. And also, ultimately, I think, looking at the composition of the Fed, there are 7 members. He chairs the meeting, but also the 7 members have to have a conviction around the monetary policy. So right. It's not the entirety, it's not just the Fed, but it's the entirety of the Fed, which is again making the decision.
Okay, Ecaterina, Bigos will be staying with us here alongside as we go into the Hong Kong reopen today. Just very quickly, we have the reference rate of the day out of the PBOC, 7.2074 here against the U.S. dollar. In terms of what the spread is to the estimate of 728.92. I'm sorry, that's a lot of numbers, I know. Slightly narrower than previous days. We're weaker, as you can see on the currency. We're back to a 730 handle on dollar offshore China. Going into the open today, Shanghai, Shenzhen, and the reopen here in Hong Kong, 14 good minutes away. Futures are pointing slightly to the upside. Last we checked. Oh, I'm wrong now. Live TV, folks. This is the China Show. Good morning.
Welcome back. You're watching The China Show. Welcome to Tuesday. We're seeing, of course, a couple of things that we're keeping an eye on, including Hong Kong markets reopening, but the Hong Kong dollar also nearing the strong end of the trading band. And, of course, this is partially to do with a function of the dollar slump, but Chinese money going into H shares as well. In terms of sectors we're watching, gold, certainly one we're keeping an eye on. Is it overbought? And we also have some headlines in the way of EVs. Does self-driving in China see a bit of a regulatory hit given some scrutiny in the sector now? Also, CATL, some of the batteries getting teased and really causing a stir, along with some of the earnings that we're expecting from ZTE and China Mobile, David.
Yeah, in fact, let's get more on the CATL story. That's really one stock we're tracking here today. Joining us here on set is Charlotte Yang, our Asia Equities reporter. Still with us is Ecaterina, Bigos, of course, out of AXA Investment Managers. Okay, why don't we start with CATL? What's key here?
Yeah, so we're watching CATL and its related suppliers along the supply chain after the battery giant just unveiled its latest technology in the battery space. And also this week, is the Shanghai Auto Show. So a lot of investor interest is in the auto and also the battery supply chain. Also, we're watching NIO, which has just unveiled its new model under the third brand last Friday. Yep. So we are, the EV space is what we're watching. And
Huawei suppliers are also going to be in focus too. This is suppliers on the chip side of things.
Yes. So so Reuters reported that Huawei will start a mass shipment of its AI chip to the Chinese consumers. So the Huawei suppliers could also see a lot of actions today. And on the gaming side, the Chinese regulators have just announced 127 online gaming titles, which we saw Tencent got 2, and also NetEase, and we could expect Tencent to unveil more details about new games because they have a conference today.
Okay, JD.com because of?
There was a lot of online bashing between JD.com and Meituan on the food delivery space, and we already saw their shares, there's some weakness last week because the two the competition keeps escalating. So that's what we're also watching today.
It's good for consumers, right? If it's going to be cheaper for everyone. Meituan was down overnight. Fantastic there. Charlotte Yang here, giving us a preview of what to expect here today. Ecaterina, Bigos is still with us here. Just your expectations ahead of this reopen today.
Well, I think there is clearly this uncertainty, but if you look at how China has performed into kind of the Easter break and as performing, I think there's some floor resilience, and ultimately is the investors still expecting for policy to come and save the day, so a lot more policy support. And I think if you had to look at the way the market has rallied, it hasn't been uniform. It has not been a bitter rally for China equities in the kind of the last couple of weeks. It's been very much driven around the expectations where that policy support potentially will go, and certainly places that are beneficiary from the consumer sentiment revival because of the policy being direct in that sphere, certainly have done better. And that's expected to stay. Clearly, any disappointment around the timing and the scale of that policy arrival, I think, will probably bring some disappointment to the investors.
Right. And, Charlotte, I know we've been waiting for easing coming out of the PBOC. We've been talking about triple R cut. They haven't done it as well. What are your expectations right now in the market for policy support?
So policy support, I think the expectations are way there, and I think it will keep building up unless we see, given there's no signs of reaching any sort of agreement yet between the China and the U.S. side of things. So, but currently, I think investors are watching for upcoming policy meetings or any gradual stimulus on for example, the consumer sectors for covering trading programs before we head into that.
Okay. Final question, at least on China here. So what are some of the investment themes we're ignoring because of the noise taking place externally? What will, I look back at right now, regret not buying and at least looking into?
Well, I think tech is still very much there. I think, especially for China, and I think there's a slight, if you might call it, decoupling from what the tech in the U.S. is going to do and what China tech is going to do, because, of course, we have different models that are now operating in each of those economies. But the tech in China is getting implemented very quickly, particularly at this stage, first stage, into consumer companies to make a consumer experience more effective, more efficient. And ultimately, I think this crystallizes into a better consumer environment because, again, China ultimately has to bring consumer back. So whatever you're doing through a better consumer experience, what you're doing through support, I think a cumulative action like that will get the consumer to spend a little bit more out of the savings that they currently have.
All right. Ecaterina Bigos will be staying with us. Fantastic, really, on the note that she was just pointing out there, of course, the JD.com story and support for the... I must have thanked you 2 or 3 times already. I mean it this time. Thank you, Charlotte. Thank you so much there for a preview of the trading day ahead. Hang Seng Index going into the open today. Pre-markets are pointing to about 7 minutes of the opening bell. Dollar China seeing a little bit weakness coming through here, 730, and I think leg higher as well there on that pair, 6.30 away. This is the China Show. We're seeing a bounce in U.S. futures right now after the drop that we had overnight. So as you can see now, 0.6%, session highs right now. And it's the opposite though, as far as Europe and almost the rest of the Asia-Pacific is concerned. We're seeing some weakness coming through in the equity complex here as we get into the open Tuesday. Avril.
Yeah, we're seeing the dollar also picking up a little. Take a look at how the Hang Seng is faring in the pre-market, a little lower, keeping an eye on tech shares as well. That seems to be the drag for now. Of course, dollar China has been behaving quite range-bound past couple of sessions with Hong Kong shut. Today, sitting above the 730 handle. In terms of stocks to watch, we've seen some of these gaming approvals out of China, and they've been looking pretty stable. So expected to be a sort of boost for the likes of NetEase and Tencent, although it is seemingly treading water on NetEase's stock at the moment. Plenty more ahead. Keep it here with us.
Good morning and welcome to the show. So we're going into the reopen here in Hong Kong, the Tuesday session. Some random trivia for you guys. Most, if not all days of the week are, in some ways, the etymology is traced back to the planets and the name of the planets, right? So, Monday, Avril, this is random. Monday is the moon, right? Lunar, lunes. Martes is Mars, and of course it gets us into Wednesday, but we can talk about Wednesday. 15 seconds to the Tuesday open. Avril.
Yeah, I'm trying to see where you're going with this etymology, David.
Nowhere.
But taking a look at, we're seeing Chinese markets reopening, right? We're keeping a close watch on Hong Kong, as you alluded to a short while ago. But when it comes to the mainland, this is the setup. We're seeing that pick up when it comes to Chinese bonds, a bit soft. Overall, it does feel like bigger, better stimulus is still required. This cloud of the trade war, we have the likes of Goldman flagging a sharp slowdown they're expecting for Q2 China growth. We're keeping an eye on the home team, potentially how active they are, given what we saw last week. week. And of course, amid all this, we're keeping a close watch on the stock of CATL. It's teaser for batteries, 5-minute EV charging, following on from BYD and the stir that it caused, a stock that we're keeping a close watch on today, seeing it down in the early goings. Flip the board, take a look at Hong Kong as we are opening up, and that handover from Wall Street, perhaps not helpful, but of course, this is also a bit softer of a picture you're seeing. No thanks to, I think, this economic weakness that is projected for the Chinese economy, and property, tech, among the sectors that are treading water today. Of course, among the movers, we did get some gaming approval, so that's expected to benefit the likes of NetEase, Tencent, trading a bit mixed at the moment, but keeping an eye as well on some of the rivalry between these Chinese food delivery companies, right? JD has just been trying to wrest market share from Meituan, and it's adding more delivery riders, but stock is down today. Flip the board, a couple of other things we're keeping a close watch on as far as earnings are concerned. We're expecting ZTE as well as China Mobile on tap. For Gore-Tech, this is an Apple supplier. It was a miss. Meantime, for iFlyTech, AI player, it was a beat. So a couple of things we're watching, but we're seeing mostly a downdraft in stocks today. David?
Looking at the earnings, looking at the capex, looking at the guidance there across not just Chinese corporates, right, really across the world, to give us a sense how bad the slowdown might turn out to be, really depend on how much those companies are willing to extend their capex spending. Right. Let's talk about these conversations around, do we invest around the assumption that we are entering into some softness, into a recession? Ecaterina Bigos is still with us here, CIO for Asia, ex-Japan Core Investments at AXA Investment Managers. Do you buy that we are going into a recession? Is it too early to make that call?
I do think, it's too early. I think we've seen an inflow of revisions into recession. We had the set when the tariffs were announced. A lot of this has been pared back because, of course, there's a lot of uncertainty, and that delay of 90 days has scope to have a positive surprises. Again, the more positive outcomes we have, negotiations, again, trade deals that are positive will certainly provide not just support for investment, but support for the broader growth. I give clarity to the corporates to continue kind of investing and deploying into growth. And then the other part, which is, again, different to U.S., to everywhere in the world, over the last, I would say, 3 to 5 years, we've seen significant investment being deployed into U.S. through fiscal stimulus. We had the Inflation Reduction Act, we had the CHIP Act, which has deployed significant amount of money into growing certain spheres of the U.S. economy. Then we also had FDI flows that has been directed over the last couple of years into the U.S. Again, we might have a pause of that, we may have uncertainty, but that's already, some of the capital is already there. And we might have additional, redirection of that investment coming post these trade negotiations. So the investment has scope to certainly stay a lot more resilient and, again, provide that support to the labor market. And we've always said that in absence of layoffs in the U.S. economy, I think consumer will stay resilient. They might stay selective. They might be a little bit more reserved in consuming excessively, accounting for the saving pools being a bit lower. But if the income is coming from the labor and is positive, I think that will continue to keep it supportive.
Yeah, the U.S. jobs market really key to watch here, Ecaterina. But when it comes to the element of higher, elevated U.S. yields, do you think that also has sort of feedback into the U.S. economy in terms of higher borrowing costs? Could that potentially exacerbate a slowdown? How are you viewing this?
Yeah, absolutely. No, I think this is one consideration that we also have talked about is financial conditions. This is not just the absolute what the Fed does, but is also financial conditions when it comes to what we've seen post the announcement of those tariffs. We've seen spreads widening. We've seen significant equity sell-off. And then, of course, we have a Fed that is still at the moment on pause, which has led to a significant financial conditions tightening. So a continuation of that, of course, will put a question in the ability of companies to, as I said, grow and start to deploy back into risk. But also we could put questions for the Fed on what the trajectory should be from there. We've seen a financial condition easing from that point onwards. That's not a risk as of yet. But of course, if those tighten again and get to a situation where it's prohibitive to the economy to grow and continue to operate, certainly the Fed will have a bigger weight on that.
What about when it comes to the dollar slump? I mean, we see how the depreciation in renminbi the past week has been slowing. There has been all this talk about, China allowing a bit more wiggle room for yuan depreciation to mitigate the impact of the tariffs. But how do you think they're viewing things now? We're seeing the dollar slumping, but yet a weaker yuan fix today.
Yeah, I think from the dollar perspective, I think we have to look at the individual country. If you look at the performance of the composite basket is one thing, but also you have to look at the individual dynamic between China and US, or yuan and the US dollar. You have to look at Japanese yen and US dollar, and you have to look at euro and US dollar. There's been a different magnitude of adjustment for different drivers. Again, we have divergent monetary policies. We have divergence policies coming through. Again, expectations that China will do more with regards to fiscal stimulus, whereas I said the situation for the Fed at the moment is a lot of uncertainty around tariffs, and a lot of uncertainty around the trajectory of the monetary policy. And again, the more certainty comes as we go through this 90-day period, I think more stabilization will come with regards to the appetite for dollar assets. Ultimately, again, I think this is an indication that investors are wary, investors are concerned about the value of deploying into U.S. assets. But again, as I said, we have a 90-day period. Any positive news that could reverse that sentiment pretty quickly.
There are some of these factors that we can't quite control in terms of trade policy clarity amid this 90-day reprieve. But in the meantime, we're keeping a close watch on earnings. That is something that, potentially provides more clarity for investors when it comes to PEs. When you're watching the Mag 7s, some of those that are reporting this week, and the next, what do you think is the potential, and what do we need to see for there to be a floor under U.S. markets?
I think from earnings, we've talked a bit earlier with David, again, we'll look at the earnings itself, but also what is going to be the forecast, what are the expectations for them to be able to operate in this new environment, how they're recalibrating the risk. And also for the Magnificent Seven, ultimately, any indications that there's a monetization of the investment or the capex that have been deployed into AI, I think that will have a positive impact on the Magnificent Seven. As I said, that tech story, particularly for the U.S., has gone into second stage because of the tariffs uncertainty. But again, any developments in that sphere, any indications that there's a monetization of that will certainly have put a positive impact or positive pressure on those valuations that at the moment, arguably, you could say, are somewhat attractive relative to where we were starting at the beginning of the year.
Final question. We haven't talked about credit and the role of income in this sort of environment. Just your advice on how I should be looking at income strategies at this point, and credit specifically. Of
course, yeah. And then if you look at the performance of credit and fixed income more broadly, and in terms of the magnitude of re-rating, the rating that we've seen, equities versus bonds, those have derated by a low magnitude. Again, it's provided some degree of buffer. The challenge for credit assets that have an inherited rates risk, because we had Treasury selling off at the same time that everything sold off, didn't act as a buffer. But spreads, or the income that I just talked about, certainly provide that resilience into the bond portfolios, right? So we still stay constructive, particularly where the yields now, the spreads have widened. Fixed income has a much more attractive carry that you actually can harness. So the investors can diversify. We stay a little bit more defensive in terms of spreads and duration, because we do think the susceptibility to spreads to potentially be more volatile, not necessarily widen significant in absence of recession. Again, spreads will not widen significantly from here, but some volatility is probably warranted. And then, of course, rates, I think that we'll see volatility until we get a landing where the Fed is going to go and how this is going to get resolved. Yeah.
Hopefully there will be a landing.
A positive one.
Yeah. Ecaterina there, thank you so much. Ecaterina Bigos there, of course, out of AXA Investment Managers. Okay, let's pivot now. Dollar is bid. As you can see, U.S. assets are seeing somewhat of a rebound right now. CATL down about 1.1%. We're coming off lows a little bit right now. The story here is 5-minute charge gets you a longer way than we expected it to. Just last week, really looking into thinking there. Let's have a listen.
The second-generation Shenxing is fully compatible with the latest megawatt-level superfast charging station on the market. We look forward to collaborating with more industry leaders to push the limits of the superfast charging through the true innovation. So let Shenxing superfast charging battery become the standard for the electric vehicles.
Min Lo is here with us to help us unpack how big of a game changer this new technology could be.
Yeah. Well, obviously, it's going to encourage more mass market adoption of EVs because one of the barriers to buying an EV is the perceived limitation around the range of an EV. So CATL is unveiling this battery that can charge within 5 minutes and offer you 520 kilometers in range, which is further than what BYD announced sometime back. 400 kilometers was what BYD had. And this is not the only innovation that CATL unveiled. They also announced the launch of this sodium-ion battery, which is more weather resistant, so it can operate in very cold conditions like negative 40 degrees. It's also, because sodium is more stable than lithium, it's more fire resistant, so it's safer and it's also cheaper than a lithium ion battery. So CATL is expecting that this battery could eventually replace about 50% of the market share that is now dominated by lithium, phosphate or iron batteries. And they also unveiled this dual power battery that can offer you 1,500 kilometers in range. So it combines a regular fast charging battery with an auxiliary pack to enhance the performance. So just the speed of all these innovation really shows you how competitive the domestic market is. And the CATL executive did mention that this rat race, while it's good for innovation, he said it's actually not too healthy, that price competition there. And he hopes that the highest standard that China can set would get rid of some of the poorer quality products out there.
I mean, when it comes to competition, it's not just among the battery makers, among the EV makers as well. And we're hearing that Nikkei is reporting BYD looking to launch something in the Japanese market by early next year. I mean, how would that even work, given how difficult it is, we know, to crack the Japanese auto market?
Yeah, so BYD is planning to launch a mini car in Japan by 2026. Mini cars now make up about 40% of the Japanese market. And like you said, because Japanese roads are narrower, they have very key specifications for cars to operate. They're very tight safety standards as well. So these are some of the non-tariff barriers that the US has complained against. And BYD has independently come up with a car that meets those specifications. And it's going to be a threat to these domestic car makers that have been dominating the market. And these Japanese car makers, they have been already facing declining market shares overseas. Some of them are making losses, having production cuts, job cuts. And on top of that, they now have to face those reciprocal tariffs, the sectoral tariffs from the US. And don't forget, there is the US-Japan talks where the revision of safety standards is on the table. If Japan compromises and agrees to accept US safety standards, that opens the floodgates further for US car makers to push and make further inroads into Japan. So a lot of competition coming for the Japanese car makers. At the same time, it's also, of course, BYD's way to grab market share overseas to increase their profitability. And this comes as BYD also recently signed an agreement with Saudi Aramco to combine forces in research to improve efficiency for new energy vehicles, which is quite an interesting collaboration given that Saudi Aramco is a traditional oil company that has frequently expressed its skepticism over the pace of this transition away from fossil fuels.
Yeah, and it's also coming at a time when Saudi Arabia is trying to diversify its economy a little and, you know, taking pains to make headways in new energy. Our China correspondent Min Lo for us there. Thank you so much. We'll have a lot more ahead from the Shanghai Auto Show, which of course starts tomorrow. And among our guests, James Peng, the co-founder and CEO of autonomous driving tech company Pony AI. Catch that exclusive conversation at the Times on your screens. Plenty more ahead. This is Bloomberg.
Welcome back. Just a quick update of these markets. Some good news if you're thinking about getting back in. We're coming off lows a little bit right now across cash markets. U.S. futures are, in fact, now at session highs, nearing about 0.7 of 1%. European futures down as much as give or take 0.5 of 1%. We're coming off a little bit as well there. But the Tuesday session is young. Hong Kong is reopening to the downside, as you can see. Lots to talk about still here. Avril.
Yeah, I think the Tuesday turnaround only applies to U.S. stocks, looking quite soft elsewhere in the region, including in Hong Kong. And of course, this is against the backdrop of the overhang of the trade war and the idea that in a trade war, much like wars, nobody wins. We have the likes of the CEO of Japanese beverage giant Suntory Holdings saying the current situation regarding U.S. tariffs is really concerning. Takeshi Ninami told us why he sees the additional levies hurting both the American and Japanese economies.
If the current tariff negotiation continues as it is, we will be perhaps impacted negatively, perhaps from 1% to 1.2% against GDP negative.
That's for Japan.
Right. So that's really concerning, especially like Hiroshima, where Mazda is operating. They would lose lots of jobs.
Yeah.
So we have to be really anxious, and we are.
And we're not even talking about the U.S. economy, which could also obviously face inflation. Are you seeing any changes in your business?
Yes, I think definitely consumer confidence has been waning tremendously. And consumers are not spending willingly nowadays, so they go to the economy instead of the premium products. So that's really concerning too.
You're already seeing the shift in consumption trends towards affordable products.
Yeah, right, that's right.
The thing right now is that President Trump really wants these tariffs in order to bring investments back to the United States, in order to bring supposedly jobs back to the U.S. How difficult is it for businesses to make those commitments in the U.S. market when it's so uncertain?
Well, under the current situation where U.S. economy might go into the recession, it's harder and harder, right? If the economy is good just like before, around the time the U.S. productivity is pretty high, above 2%. That's why U.S. attracted investments from the world. If that situation continued, we would have a strong appetite to keep investing in the United States. So current tariff situation is losing the appetite from other countries to the United States. So this is really, killing the appetite from the world to the United States. So we are losing the appetite to invest in the United States. As a matter of fact, if the economy goes into the recession, right?
Basically, what's happening is that, at least for now, these tariffs could be backfiring on the health of the U.S. economy.
Exactly.
The logic from the Trump administration is that he wants to change what they call unfair trading practices. Are you concerned long-term that this might be an end to rule-based globalization, free trade?
Not really, because Japan and the other countries are promoting CPTPP, for example, and RCEP. And China is another locomotive to promote the free trade. So whether it's a good thing or not, I think we'll be promoting the free trade in, for example, APEC, including perhaps eventually India. So without the U.S., some countries, including Japan and China, we want to promote free trade.
Can the rest of the world carry the global economy without the world's biggest economy?
I think so. This time, a lot of countries got understood that the U.S. is not the country to support the free trade. And the U.S. denounces the free trade. Bringing the bad situation to the United States. But the free trade creates the, good job creations and, world trade, in history. Lots of innovation happens. So I think Japan should be a flag bearer of free trade, and we will.
And that was Takeshi Niinami, the CEO of Suntory, speaking with Sherry earlier on here on shows. Now, if you're one of our Bloomberg clients, you can check out that specific interview or others that you might have missed here. Scroll back on TV Go. That's the function you run to get this. And yeah, join the conversation. You know how to reach us through our IB chats. And if you have any questions for other guests coming up here in shows, you get a full agenda coming through here on TV. So send them in. Send your thoughts in. Plenty more ahead. This is The China Show. Right, welcome back. Gold is continuing to hit highs, as you can see, up about a third on the spot market. You look across the futures curve, that's still what we're seeing just about across the board, all throughout contracts to 2026. In fact, in a couple of minutes here, and as we flip the page and have a look at the big moves across the cash equity market related to gold here, in a few minutes we'll be looking at the charts here. There are some signals that some of the bullishness surrounding gold, as far as speculative bets are concerned, are starting to come off a little bit. So might that be actually a sign that of a turn in prices? Gold's obviously looking very extended in itself against silver, for example. So stay tuned for that. Very quickly, Meituan and JD.com in focus here. Of course, JD.com and effectively detailing some of its plans to maybe eat away at some of the business of Meituan. Both, as you can see, are down and down substantially at the reopen here in Hong Kong, just divided by 2, of course. No, by 3, actually, because we were shut as well here on Friday. And yeah, Avril, what are we seeing as far as the benchmarks go?
Yeah, I think it's mostly that downdraft, right? Looking quite tepid today. Hang Seng down 0.5%. Not a lot of risk appetite given the cloud of the trade war. What's rising though? It's still these Chinese bonds. Dollar China nudging towards the 732 handle. We'll have a lot more on the way in the next hour. You're watching The China Show.
Welcome back. You're watching The China Show. We're just going into the second hour of the program here. So Hong Kong markets reopened today after being shut Friday and Monday. Element of catch down, as you can see on your screens. The good thing, though, and we'll get into this a bit later on as well, the pullback we've seen in U.S. equity markets is seeing somewhat of a floor, and I suspect I'm speaking a little bit too early right now, but you are seeing a sizable move to the upside and bounce across U.S. futures at this point in time. The rest of the region, though, similar moves we're seeing here as far as price goes, Avril.
Yeah, and this bounce back in U.S. futures also coming with a pickup in the dollar. So a lot of these Asia currencies also treading water. But stocks, it's a bit of a different picture. Not as bad as what we've been seeing in the past couple of sessions, but Nikkei a bit softer, as is the ASX. Really moving sideways, I think, quite range-bound until we get more clarity as far as trade policy is concerned. But it does also feel like some of the worries, the angst, not just about the trade policy, but, you know, when it comes to Fed independence, maybe there are some in the markets that think that it was overdone. You look as well at commodities. Brent, after the slump just a day ago, no thanks to being part of that risk-off, concerns as well about global demand. We're seeing that pick up towards the 67 handle. Among the commodities that are seeing a bit of green today, David?
Yeah, no, absolutely. In fact, I think just let's have a closer look at gold right now. So just, again, a crazy rally. Yet again, you're looking at the gold curve. This is the June contract, I believe, which is the most active, I believe, right now in terms of open interest. You go all the way through to October, and you have a 3,500 level handle on that already, 1% just about across the board, right? So we're looking at technicals right now. Are there signs of overheating? I think when you look at things like momentum, for example, first chart's going to show you this 14-month relative strength index of gold. So we now have get this, an 87 handle on this specific gauge, which effectively takes you back 45 years. Last time gold had this much monthly momentum was in 1979. Point number one. It's up to you what to do with that information. Point number one. Point number two coming through as well. As prices move up, we've started to see long positions start to ease off a little bit right now from reaching effectively multi-year highs back to 2022. So at these levels right now, still net long gold, but that's the smallest net position going back about give or take a year or so. Now, are these guys correct? Only time will tell. As you can see, price is still continues to find new highs as well. The other thing, and I think we've showed you this chart a few times over the last few days or so, the gold-silver ratio, right, which is effectively measures the price of gold to silver. When the chart goes up, gold outperforms. The opposite is true when the chart goes down. Now, typically, 80 to 90 was the level to the upside that then precipitated a reversal lower. In other words, gold started to underperform silver when we reached about that level. We've not just gone past that level. We've taken out 100. We're now trading at 105. So we've only traded at this, this ratio has only been in triple digits thrice in the last 50 years. The early 90s, the height of the pandemic, and where you are currently. So again, Avril, what to do with that information, I'll leave it to our viewers, of course.
Yeah, and I think it's really a function of this uncertainty that we've been seeing in markets, right? Whether you're talking gold or silver, the angst when it comes to concerns about Fed independence. We're hearing from Trump, again, he's not just doubling, tripling down on threats on Powell that sense that he might seek to remove the Fed chair before his term is up, warning that the U.S. economy may slow if the Fed does not move immediately to reduce interest rates. So there's a lot at stake, but there's also the question, are markets overreacting a little to all this?
Yeah, it's a question certainly worth asking. I mean, when you know, in addition to this, right, so going into this, even before the focus, part of the focus of the market shifted to, you know, Fed independence, we were already looking at a risk premium being built into U.S. assets. And then, the U.S. president said, he has every right, of course, to talk about, give his opinion on where the economy certainly is. He talked about, and I think when you're looking at here, these are betting markets that currently still have about an 80% probability that the Fed chair won't go, unseated or seated, will remain seated as well. Let's listen into the U.S. president on how he described the U.S. economy right now.
We're going to ultimately have a deal with anyone. If we don't, we're going to make it anyway. But we're going to ultimately have, the economy is very good. We don't have inflation. Energy's down at the lowest it's been in years. We hit actually $1.98 recently in a couple of states. I think we're doing really well. We're all set.
Yeah, and David, let's also bring in a guest to talk us through, some of the analysis, not just what betting markets are looking like, but also how, this really has played out in the curve steepening. We've seen that on the long ends, investors wasting no time in terms of punishing U.S. assets. Let's bring in Ben Powell, Chief Middle East and APEC Investment Strategist at BlackRock Investment Institute. So, Ben, first off, your take on all this. Are markets right to be this worried?
Yes, good morning, Avril. Great to be with you. We think that we are moving to a fundamentally different epoch in financial markets. That's a big statement, but that's what it looks like to us. We've had significant changes in the structural side of the global economy. That's actually been taking place for several years. And we see President Trump as something of an accelerant for these pre-existing trends. But he is accelerating them. I think the US now has something of a risk premium. That's very different to where we were just a few years ago. And it's going to take markets a period of time to work through that. So
more to come is what you're saying when it comes to dumping of US assets potentially?
I wouldn't say dumping. The US is still the US. That's not going to change. The dollar's still the dollar. So to a degree, there is no alternative. I think a lot of people are scratching their heads looking for one, and we're seeing flows into sort of everything, some of the smaller markets and gold, of course. But for now, it's still a US-centric world. That's not going to change. But maybe we're moving to a world where even the so-called risk-free assets has a little bit of a risk premium, and that's a very big deal.
When it comes to the alternatives that markets have been searching for, a lot of it has gone into the euro, it's gone into the yen. You like Japanese stocks still, right? How do you think they're going to be dealing with the yen appreciation?
So I'd say a couple of things here. Firstly, we think that we've moved to a different market environment, very much different from the kind of risk-on frame from 5 years ago. The Great Moderation, approximately everything went up. Now we think investors need to really pick their spots. So the first thing I'd say as an investor is we need to move away from a simple, even naive, risk-on, risk-off approach to being much more granular, much more targeted. One of those areas we like is Japan, but it's a particular nuance even within the Japan call fundamental, much more to do with the domestic economic renaissance. So nominal GDP very low for 30 years has now picked up as inflation has recovered dramatically. That's very different and should be good, relatively better for some of those companies who've got the ability to put their price up for the first time in maybe 2 generations. So that, combined with the corporate governance reform story, which I think is well understood and has been going on for years, but is kind of a huge deal. So moving from treating shareholders how they were treated to a little bit better is a very big deal. So for overall, that makes us overweight Japan. And again, I want to extrapolate that into the broader point. It's not a risk-on story, a global risk-on. It's a very particular kind of niche story, if you like. Japan's a big niche. But we think that's how investors are going to need to approach investing in general. Exactly where do we want to be exposed? Much more picky, much more granular, rather than that, as I say, old-fashioned, naive, beta risk-on approach.
When it comes to the structural drivers that you talk about, including AI, how does that kind of feed into the rest of Asia and what you think looks attractive aside from Japan? Yeah.
By the way, there are other stories apart from the US and the trade tensions. I totally get why it's been front page news, actually maybe the first 10 pages of newspapers over the last several weeks. Fair enough. But we do have an AI revolution going on. And actually, if you've been paying attention, the last several weeks have been more amazing, right? Even more amazing around all of that stuff. We've had comments from various tech AI leaders that their servers are melting. So it seems like the demand for intelligence, the silicon variety, is still very huge. It feels like the combination of more compute and more efficient usage of that compute, the so-called DeepSeek moment, all of that, that is still absolutely ongoing. And the implications of that are very, very positive for certain companies, certain sectors, maybe even at the macro level. So I totally get the attention to trade. Of course, it's very important. But there are many things out there that we can be positive about, or more positive about, and AI for us at BlackRock would be one of those.
Ben, David here. I mean, just to follow up, I guess, on that, we've heard from the likes of, just to name one of the companies, NVIDIA, for example, just as an example there, that have pared back some of their, let's call it short-term outlook on the industry. You're not, in other words, do warnings coming out of these big names in any way affect that underlying thesis you just laid out for us?
No, not for us. It's a mega force, and we think this is going to be a consistent driver of returns for years to come, frankly, David. So valuations, obviously, we can discuss. But in terms of the question you're asking, I think, is AI a real thing? Is it ongoing? Are we nervous about the overall theme? We're absolutely not. We continue to see very huge demand into those chip suppliers and the overall supply chain. And having some negotiations around pricing is quite normal. So we're seeing companies, it seems to me at least, messaging into the market in a sensible way, because nobody wants to say we need to buy these chips at almost any price, right? So we're seeing messaging into the market, which makes sense. But in terms of the overriding kind of demand, we still think it's there and it's very strong.
And it takes us back to the initial premise, Ben, and I was curious to get your thoughts on this. For many years, people have argued the U.S. dollar was overvalued. Large parts of the U.S. equity was overvalued. So this adjustment we're seeing now, is there anything that tells you this is something beyond your usual reversion to the mean? Or is this simply one of those corrections when we look back in time, there was nothing special about what took place in April of 2025?
No, we think it's potentially special, let me say that. So we think there are huge structural changes to the supply side of the global economy, and we don't think this is a reversion to the mean story. We think this is a fundamentally different investment situation which investors are going to have to adjust to. So for us, that means a new investment playbook, being much more picky, much more selective, much more granular as to exactly what you want in the book, rather than just having this kind of risk-on approach, which works so well in the Great Moderation when inflation was low and central bankers could kind of bail us out at the first sign of trouble. That's clearly not the case anymore. Central bankers are constrained by the inflation side of their mandates. And therefore, I think, David, we're going to have to go back to like old-fashioned analysis of companies, cash flow earnings, valuations, all of that, rather than just riding a central banker, everything going up tide.
Yeah, and I guess before we talk about those other themes, I just want to get your thoughts then. What do you think about what the U.S. president is doing here in terms of pressuring, since you brought up central banks here? How do I look at that? Is that simply just noise at this point?
I don't think it's noise. I think it's very important to consider the fundamental, I guess, precepts on which we've had US exceptionalism. It's much too early, I think, to declare that those are anything like over. As I said, the US is still the center of the world, the financial world. That's not going to change probably in our lifetimes, David, I would guess. But I think even flirting with adjusting norms is something the market's going to need to think about. And this feeds into a broader sense that the US is moving from the so-called risk-free assets to something that in particular overseas investors need to be more thoughtful around. So that has important implications in turn for US yield. So around 30% of debt, US federal debt, is owned by foreigners. I think many foreigners are going to be thinking about the potential for a risk premium in the US and looking for compensation accordingly. And that for us, David, means US 10-year yields probably over time can continue to drift higher.
Ben, I wonder if you'd be able to weigh in on this when it comes to Trump targeting the Fed's independence. How are you viewing it in the terms of, what we're seeing in APEC? And does this sort of open up a precedent for APEC governments targeting central banks? That's an element we've kind of been seeing in the past year or so, particularly in Southeast Asia.
Yeah, look, I think it's normal in a way that as we go into a more difficult growth environment, which seems to be the case today, that politicians, leaders naturally are interested in getting as much support as they can for supporting the growth side of their mandate. That to me seems completely normal and logical. And what we're going to see all over the world, maybe including in the US, certainly here in Asia, is a test of various central banks' independence. It's going to be very interesting. And what I would suggest is these kind of tests are going to have long-lasting implications. So obviously there's the kind of short-term, next 3 months tactical view, but if it turns out some of these central banks are more or less independent than we thought, then that has ramifications for how we think about all of these different countries from a more strategic investment perspective. So it's a test, right? This trade tension is putting stress on all of us. We're all working hard in different dimensions. That includes prime ministers, presidents all over the world. And there's going to be interesting data that's kind of flows from this test with very, I think, significant longer-term implications.
And Ben, as a final question, I realize that we've boxed you in certain topics. The nature of news, apologies for that, but yeah, thank you for playing the game. Well, I mean, to the point you're making, right? People are trying to figure out what's noise, what is agnostic of news cycle, and you've underscored repeatedly throughout the last few minutes, the structural changes there. You mentioned Japan. Leave us with your final thoughts. How do we need to be thinking about that longer term? What advice would you give?
So look, I think we can actually be more certain about the longer term. So some of these mega forces, energy transition, demographic divergence, and AI for us still kind of front and center, I feel much more confident about those than I do about what we're going to see on Truth Social or Twitter in the next 24, 48 hours. So for us, there's a real risk of kind of being whipsawed around tweet by tweet. Of course, we've all got to pay attention. It's moving markets for sure, and I don't want to underplay that. But stick to what we feel more confident on, which is actually the longer-lasting mega forces. Those we think are going to persist almost regardless of the political news flow, and that's where we can, to some degree at least, hang our portfolio hats over the months and years ahead.
Ben, fantastic. Thank you so much for joining us and taking the time to join us today. Ben Powell, their Chief Middle East and APAC investment strategist at BlackRock Investment Institute. Right, some breaking news right now. We were down as much as 8%. We're coming off lows a little bit, but that's just being kind and generous here. We're still down substantial in JD.com and also Meituan as competition heats up between the two. Really just to underscore the point that, while how do we frame this from a macro perspective, support for the consumer to get consumption up will come in the form maybe at the expense of margins. That's a good way, I think, of putting it right now. We'll unpack the story for you later on. JD.com, of course, came out with some details on how they plan to encroach on some of the business and revenue streams that Meituan already has present in this market. Plenty more ahead, including that. This is Bloomberg.
Welcome back. You're watching The China Show, and as we keep tabs on this trade war, it's really also about what countries have been doing to respond to tariff threats. And Bloomberg has learned that Japan is setting up a new group of officials from various ministries to respond to Trump tariffs. Prime Minister Ishiba has told Parliament his country will not just keep conceding to U.S. demands to reach a deal. Bloomberg editor John Herskovitz joins us now from Tokyo. John, first off, what does Japan want to achieve from the talks, and what does the U.S. want?
For Japan, the main thing is just getting a lowering of the tariffs. We have the sectoral ones, which are hitting autos. We have those ones separate on steel. And Japan is a steel manufacturer. It's one of the big auto exporters of the world. And then there are the general tariffs, which have been on pause, but still we have the 10% rate. So Japan's floated a couple of things which have been reported on in the local media over the past few days. One is getting rid of some non-tariff barriers. These are some safety standards, some inspections for cars, which could help U.S. cars in the Japanese market, or that's how they're going to portray it. The other is agriculture, perhaps allowing for more rice imports and purchase of more U.S. soybeans. For Japan, these are politically okay to do. The rice farmers are a main base of support for the ruling LDP, but there's a bit of a rice shortage going on now in Japan, so making some concessions on that front would be okay. For the cars, lowering the effective tariff for U.S. cars now is about zero. By shifting some of these safety standards, it in theory would allow for more market access, but there really hasn't been any significant inroads for U.S. cars into the Japanese market. For the U.S., what they want that's the big question. Is it just going to be a narrow deal? This is the first big one that the Trump administration has talked about since it announced the global tariffs. Or is it going to be something that includes security? Trump has talked about Japan greatly increasing the amount it spends for U.S. troops to host them, and also currencies. Japan is willing to talk currencies, but on a separate track from these trade talks. For Trump, this could be something that gets rolled into this and makes it really difficult for Japan to accept any sort of offer or deal that may come out of these talks.
And John, once we talk about the currency, if that does become a topic of negotiations, that automatically crowbars the BOJ into the broader conversation. How might this affect central bank policy?
Bloomberg put out a story this morning of people familiar looking at the Bank of Japan, which is going to keep its current policy intact of gradually raising interest rates. What's going on now, this uncertainty with the tariffs, just means that we're probably going to see a delay in this taking place. There's a May meeting coming up, not a lot of expectations that there's going to be any sort of hike. And if the hikes come, they're going to be much more drawn out than originally expected. So it's weighing on the BOJ just to find out how much of a hit the economy is going to take from these tariffs. But the overall plan still remains the same. At least that's what we've heard from Bank of Japan officials who are talking about the outlook for the central bank.
John, thank you so much. John Herskovitz in Tokyo for us, our Bloomberg editor there. Just ahead here on shows, we'll be speaking exclusively with the new CEO of Globe Telecom. Of course, the Philippines' largest telco there has a new boss in town. We'll talk to them in a couple of minutes on what their priorities are, short and longer term, and the ultimate vision for the telco coming up, of course, in a couple of minutes. This is Bloomberg.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th Pope in March of 2013. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally. But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. He left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
It's 11:29 a.m. in Tokyo, and Japanese markets about to go on break in about a minute from now. Of course, the attention has really been on dollar-yen this past week amid the slump in the dollar, but that seems to be slowing a little today, and the Japanese yen hovering at the 141 handle against the greenback. This is a bit of reprieve for Japanese stocks, particularly the export-related counters. So the declines you're seeing on the benchmarks and the broad-based gauge is looking a little flat today. Maybe also a bit of optimism given how U.S. futures, last we checked, were actually ticking higher. Maybe a bit of that bounce back from Monday's performance, but a couple of stocks that we are keeping a really close watch on as well. When it comes to Nomura, of course, one of its most significant overseas acquisitions since it bought Lehman Brothers in 2008. This one with Macquarie agreeing to sell its US EU public investment businesses to Nomura for $1.8 billion, a massive deal. We're seeing that's going to be all cash and could also allow Nomura to scoop up $180 billion in client assets. So this could mean that in its investment management division, AUM could rise to around $770 billion. So really interesting to see. I mean, we were speaking to some of our guests earlier, this realignment that's underway in global markets. It looks like it's also trickling down into deal making, and quite monumental what we're seeing from the likes of Nomura, David.
Yeah, and I guess that's a very good way to frame that. You know, we don't normally talk about Japanese financials coming out with opening their pocketbooks, buying global assets. I mean, it happens, certainly. It doesn't happen as often, and I think the point that Avril was making there, last time since Lehman. Got to say, though, they're paying a bit more than they did for Lehman. I can't remember the price tag that was involved there. Any case, a glance at markets right now. We're lower across most, not all. Volumes are on the lighter side of things. S&P futures are coming off highs a little bit, as with the dollar, which was up a lot more. We're now flat on the Bloomberg dollar index. Right, let's take a step back. Let's pivot back and have a look at Southeast Asia, specifically the Philippines, and the changing guard there, the country's largest telco. By market cap, on your screens is Globe. Share price down about 7-8%. Hardly been a good year, certainly, for overall for markets, just to put that into context. Joining us now is Raymond Cruz, officially appointed the CEO at Globe at the company's annual stockholders meeting, which I believe just concluded couple of minutes back. Good morning, and thanks for taking the time to speak with us. How was your first AGM?
Good morning. First of all, thank you for having me in this show. The first AGM went well. We had a seamless annual stockholders meeting, so hopefully it bodes well for the future of Globe, what lies ahead for all of us.
All right. Now, what everyone is, I guess, thinking, and I'm sure you've entertained the question as well, Carl, since the announcement, what are your initial priorities now for the company?
Well, I will spend a disproportionate amount of time listening to the organization, engaging consumers, and really trying to bring a sharper customer mindset. I think coming from my years of experience in the FMCG industry and having worked in a number of markets, which are slightly similar, some are probably more volatile than the Philippines, there's a sense that the demand is really driven by a very heavy consumer sector. So hopefully my training to obsess about what the consumer wants and act on it fast will do well for my new journey at Globe.
I'm sure your training with consumers will pay off. But what are you hearing then in terms of the concerns of recession or the concerns about tariffs and the impact on inflation? How might that potentially feed into the demand from consumers?
Well, obviously, it has impacted consumer purchasing power. While I think the economy of the Philippines is coming back to normalcy, where inflation is actually going down and GDP stable at about 5-6%. It is up to key players such as Globe to make sure that we actually accelerate consumer demand for telco and our products. The good thing about the Philippines, it's the fastest growing digital economy in Southeast Asia, and this bodes well for us. And the Philippines having, of course, a very young population that are already online bodes well again for the future of Globe because our future customer base is now online and actually growing.
This is also coming against the backdrop, though, of a maturing core telco business for Globe. Overall, what is that going to mean in terms of the strategy you're going to deploy to fire up revenues, profits?
Correct. So, in my first 90 days of onboarding, I looked at what made Globe successful. And one of the key success factors of the organization, besides, of course, having a great engaged set of employees and having a great culture, is the fact that everyone in the organization is obsessed with the customers. So moving forward, while a lot of people think that the industry is mature, opportunities actually abound. I'll give you one example. In the Philippines, site density is actually not that good. I think we have about close to 5,000 users per site. When you compare that to Thailand, with half the population, they're only at about 1,500 to 2,000 users at site level. So while people will say it's a mature market, yes, it is, but opportunities abound in terms of future revenue growth.
Right, and Carl, well, speaking of, since you brought up revenue growth, I mean, I think you guys cleared in the last calendar, I'm just trying to rack my brain, I think it was 180 billion, that's local currency, in revenues last year. The last few years have seen low to mid single-digit revenue growth. Are you happy with that rate of growth?
You're absolutely correct, David. So it's about low to single-digit. The guidance will remain to be low to single-digit at this point in time. While we repivot in terms of looking at how we are positioned in the mobile segment and getting a bit more aggressive in the broadband segment and also enterprise or B2B, that guidance as of now remains. But, moving forward, the ambition is to actually be the largest, most profitable, and most admired telco operator in the Philippines. And for us to attain that, we need to get to a stronger position in both the fiber market and as well B2B.
And what kind of capex are we talking for you to be able to put yourself in a position to realize those objectives?
So our capex would still be at a healthy level. We're clearing about 32-34% in terms of capex productivity, but at the same time, bulk of that will be put on and spent on obviously data. Because as I said, the Philippines is the fastest growing digital economy in Southeast Asia, in the sub-region. And therefore, to my mind, very clearly, based on what I've seen so far, Globe is best positioned to actually ensure that we benefit from that uptake.
So it's still at the same time, of course, we're seeing... We're, of course, seeing a lot of market volatility. In the meantime, markets are looking forward as well to the GCash IPO. That timeline and what we can potentially expect in terms of size, what more can you tell us about this?
Well, everyone, it's all hands on deck to actually get GCash to be at push button ready for an IPO. Tentative timing would be anywhere between the last quarter of the year or the first half of next year. So all hands are on deck to make sure that it's going to be the most successful offering in the Philippine market. And obviously, from what you guys know, the valuation the last time it was valued was at $5 billion US. We do expect, based on certain assumptions, that hopefully it could be better than that.
How much better are we looking at here?
Well, I'm not in a position, but based on what the analysts are saying, it could definitely be higher. I just don't want to comment on a figure right now, David.
Right. I think Ernest, your predecessor, mentioned. I think we spoke to him a few weeks ago. He said he was happy with at least 8. But I realize, and I acknowledge that there are lots of moving parts, including, by the way, I think your separate conversations that you guys are having with the exchange and the minimum float and what have you. Once it's listed, and let's just for conversation's sake, it's listed before the end of the year, to your point, early next year. What role will you play specifically and Globe play in terms of running that specific business?
So Globe will remain to be the largest shareholder of Mint or GCash. And of course, we have to maintain an arm's length relationship with GCash because they also serve, for example, other players in the industry. So I will be playing a coordinating role with Ernest and the team led by Martha to make sure that we continue to lead the digital and financial inclusion in the Philippines. So exciting times ahead, both for core telco at Globe and as well for fintech at GCash, David and Avril.
Yeah, and thank you for taking the time to come and share some of your upcoming plans. Congratulations on a successful first AGM. Really going to keep a close watch on how you're going to steer the business going forward. Thanks so much again, Raymond Cruz, CEO of Globe Telecom. Now, in the next hour, we'll hear from the CEO of Mandarin Oriental Hotel Group and their business outlook as they look to double the size of the group over the next decade.
Yep, if you're one of our subscribers too, you can check out that interview you might have missed here with the Globe CEO and, of course, the others coming through the course of the next few hours here on Bloomberg Television. Yep, plenty more ahead. Suffice to say, this is The China Show.
You're watching The China Show, and here are some geopolitical stories we've been following. President Trump says U.S. Defense Secretary Pete Hegseth is doing a great job despite what appear to be attacks from disgruntled employees. Hegseth is facing staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecured chat group. A former Pentagon spokesperson says the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration.
This is what the media does. They take anonymous sources from disgruntled former employees, and then they try to slash and burn people and ruin their reputations. Not going to work with me, because we're changing the Defense Department, putting the Pentagon back in the hands of warfighters, and anonymous smears from disgruntled former employees on old news doesn't matter.
Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Harvard President Alan Garber, says the freeze happened after it refused to follow illegal demands to make changes to governance, discipline, and hiring policies, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus.
Let's continue the White House coverage here. So you have the White House saying that trade talks between the Vice President J.D. Vance and Indian Prime Minister Narendra Modi made significant progress. Now, New Delhi is seeking to strike an early deal to avoid the additional tariff hikes out of the White House. Bloomberg government reporter Sudhi Ranjan Sen joining us right now from Delhi to talk us through what we know so far on the progress. Talk to us about the outcome of the visit and the meeting between the leaders here.
Well, I mean, there were not supposed to be any hard outcomes of this visit. It was, more the soft power of diplomacy that was at display. The vice president in India with his family went to a Hindu temple yesterday, and then, of course, with the children, went and met the prime minister. That was, this just kind of shows both sides trying to, develop a very strong relationship which goes beyond deal making, which goes beyond kind of the traditional diplomatic discussions that happen. But what we did see was the two leaders discuss the trade negotiations. They also discussed defense and cooperation in critical energies, and both sides kind of reaffirmed that they are very happy with the path that they have taken, and also with the progress in the relationship or in the talks and in the relationship that so far they have seen. Mind you, there is, and this is what India has been kind of putting front and center time and again, that there is a very strong relationship, a personal relationship between Prime Minister Narendra Modi and US President Donald Trump. And now we see India kind of, extending that with the Prime Minister kind of hosting the Vice President and his family at his residence.
Sudhi, to your point, I think it cannot be overstated that the Vice President of the US is on Indian soil. Maybe that boosts the optimism that, in terms of trade discussions, they can make some headway. Of course, this also speaks to that close sort of personal, private relationship. But what do we know in terms of concrete details, what we can expect in terms of concessions for India?
Yeah.
Well, in terms of concrete details, what we have heard is, there was a statement from the White House, from United States coming out saying that there has been significant progress that is made. We know that both sides, negotiators of both sides, have doubled down and they're trying to reach a deal within the next 90 days, so that both sides can avoid the tariffs. So negotiations are going on very hard. At the same point of time, we are seeing very encouraging statements coming from both sides. So one can gather, while we may not have the exact nuts and bolts of what India is offering to give and what the United States has said, while those are still behind closed doors, the general sense is that of optimism. The general sense is that between the leadership there is a lot of hope, and there is and that there is this thing emanating from India, that India will be able to secure a deal with the United States. It's about a month and a half since negotiations have started in right earnest. Another month and a half to go before the 90 days period kind of ends. So all in all, net progress seems to be quite good from the statements that we are seeing from either side.
Looking very promising on both ends. Sudhi, great to get your insights and getting us up to speed on all this. Bloomberg, Sudhi Rajan Sen in New Delhi for us. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show.
No, Avril, sorry. I was going to steal your thunder, but you're not allowing me to.
Yeah, I'm quite aggressive when it comes to defending the thunder, but David, we've been keeping a close watch on, global growth outlook, right, amid the trade war. And when it comes to those spring meetings underway in Washington this week between the IMF, World Bank, we're seeing, of course, the central bankers, finance chiefs descending upon Washington. So one of the things that we've been keeping a close watch on is how global growth outlook is going to be affected. I think the current consensus, and just to bring you in this, David, because this chart, of course, is courtesy of you. Global growth, I think the consensus is 2.8%. Slowest pace that we're seeing potentially since 2001, excluding the crisis years of 2009 and 2020. So among the things that we're going to be keeping a close watch on this week, David.
Yeah, well, first, thank you for the hat tip, and thank you for allowing me to share the spotlight with you, Avril. there's actually, and I'm glad you brought up that, because that's really data that the consensus data, and there's actually downside risk to that 2.8% number, in a sense that, I had to look at, and I can't get into the individual forecast, but, there have only been a handful of economists that have managed to so far revise their forecasts, right? And given the uncertainty out there, I can only deduce that that number likely, the future revisions likely come in lower than higher at this point in time. Well, that takes us into what's trending across newspapers across mainland China right now. And when you look at certainly how Beijing and China is looking to sort of shelter and offset the headwinds out there, one of the things is really this plan to open up the services sector. We had a briefing, of course, that took place really against this backdrop of what it describes, Beijing describes as protectionalism and, so many syllables, unilateralism, saving the syllables for last. Min Lo, who wrote that introduction, is here with us to talk us through the details of that briefing, Min.
Hi, yes.
Yeah.
Thank
you.
So there was a briefing yesterday where China is announcing this pilot plan that will be rolled out across multiple cities to expand or open up the services sector, as you said, and they are countering this narrative, saying that they are voluntarily opening up these sectors while, the rest of the world, namely the US, is, of course, seeing a lot of protectionism now. So some of the sectors, they mainly focus on a few areas. One is the financial sector, tourism sector, telecommunications is one, as well as healthcare. So some of these measures include, for example, allowing foreign doctors to set up clinics in China, supporting the establishment of foreign-owned nursing schools, reducing the foreign ownership cap in app stores, as well as, for example, when it comes to financial sector, attracting overseas insurance companies and pension funds to invest and finance the green sector. So, of course, this dovetails with China's plan to boost domestic consumption as well, because the services sector hires a lot of people, it creates jobs, and at the same time also an effort to bring more foreign direct investment into China, because the MOFCOM says that 70% of China's FDI comes from the services sector.
Min, amid all this, we've also been seeing China trying to project this defiant tone when it comes to tariff negotiations. How are Chinese state-linked media covering all this?
Yes, so today there was an editorial on Global Times, which is a state-linked tabloid, with the title, appeasing the U.S. is akin to bargaining with a tiger for its hide. So what the article was trying to say is that the U.S. is really not a reliable partner. Look at this quote. The U.S. intends to coerce and manipulate dozens of negotiating parties. These parties clearly see how the U.S. has repeatedly broken its promises and gone back on its words. And again, trying to portray China as the opposite, as a very stable partner. Here's another quote that says the U.S. is really overestimating its power. U.S. attempt to cut off China's economic and trade ties is like, quote, eating soup with a fork. And again, it echoes what the Ministry of Commerce had said yesterday, saying that, any country that attempts to kind of deal with the U.S. and selling out China will face consequences from China, and China is going to take countermeasures to retaliate against that.
Yeah, I like that analogy there. It's almost like it holds water as much as a fishnet. Okay. Min Lo, thank you so much, our China correspondent. Very quickly, two big movers to tell you about before we wrap up the show. Meituan and JD down on the back of this sort of trading of accusations, on the back of, I guess, intense competition. So we'll revisit the story tomorrow, but that's it from us here on The China Show. Avril, we'll see you all tomorrow.